C3.ai stock price is down roughly 20% in the last 5 days, and investors are wondering why the stock price is falling and asking if this dip is a buying opportunity. Well, one of the reasons C3.ai stock price is down is because the company announced quarterly earnings results on February 26, 2025. And it's not like the earnings results were poor. It's just that investor excitement for AI stocks has been declining this week, and the markets overall have been declining this week with a loss of risk appetite, given all of the disruptions from the presidential branch in the United States and the tariffs and the geopolitical tensions, etc. That tends to have a bigger impact on volatile stocks like C3.ai. Nevertheless, I'm going to review the company's latest earnings results and answer if I think the stock is a buy right now on this dip.
I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.
So C3.ai reported revenue of $98.8 million in the most recent quarter, which was up by 26% from the same quarter last year. Now, a 26% revenue growth rate is solid, to be sure. However, there was one peculiar thing that hurt C3.ai while it grew 26%. And that peculiar thing was that it had a nice streak going of accelerating revenue growth. In the previously reported quarter, which the company announced on December 9th, 2024, they told investors that they were on a streak of 7 consecutive quarters of accelerating revenue growth. And in that quarter, they grew revenue by 29%. So by increasing revenue at 26% instead of 30% or more, that streak of 7 consecutive quarters of accelerating revenue growth ended. And that streak, that increasing second derivative, was very vital to the reason why C3.ai stock price was trading at the levels it was trading at. So now with the end to the streak, the stock warrants a lower valuation from investors. One great thing about C3.ai's business is that it has a pristine balance sheet, $724 million in cash and 0 debt. So the company has a long runway. It's actually improving its cash flow from operations, which I'll touch on, and it has solid cash balances. I don't think any investors need to worry about C3.ai running out of cash before it becomes a self-sustaining business. Another thing that's been working well for C3.ai are its pilots that are turning into agreements. In the latest quarter, they closed 66 agreements, including 50 pilots, which is an increase of 72% year over year. It's a similar strategy to what Palantir has been doing, and Palantir has also found great success with this strategy. C3.ai operating similarly, but nowhere near the levels of Palantir. Looking ahead, the company's forecasting $108 million in revenue in the latest quarter, and they updated their full year guidance for, they only have one more quarter left in their fiscal year 2025, and they narrowed the guidance range. And they now expect revenue of $389 million at the midpoint. And that was updated from the previous guidance where they had forecasted $388 million at the midpoint. So their midpoint increased by, less than $1 million, but the range narrowed. The range used to be 20 million wide. Now the range is only 10 million wide. And you would expect that because there's only one quarter left in the year. So the expectations are more narrow than when you have 2 quarters left to complete in the year. So when I evaluated the company's operating loss from operations for the 3 months that ended January 31st, they actually lost more money on this metric, $87.6 million. Compared to $82.5 million in the same quarter last year. But they also generated $20 million more in revenue. So the percentage of loss from operations compared to revenue improved slightly, although I would like to see the actual number of operating loss decrease as they increase revenue, which they did demonstrate. If I look at the 9 months that ended January 31st, 2025, the operating loss came in at $235 million compared to $236 million in the same period in 2024. Nevertheless, they generated $280 million in revenue in 9 months and lost $235 million. That's the biggest concern I have with C3.ai's business is the massive losses on the bottom line that are not improving quickly enough to generate excitement from me. Although the cash flows from operations are improving, the company in the 9 months that ended January 31st, they lost $53 million in cash flow from operations. That's compared to a loss of $84 million in the same period in 2024. So the cash flows from operations are improving nicely, even though the operating income is not improving as nicely. So when I calculated the company's intrinsic value per share using my discounted cash flow valuation model, I found its intrinsic value at $32.81. The current market price is $23.05. So looking at it from a DCF basis, the stock looks undervalued. However, when I measured the stock on a forward price to sales basis, the forward price to sales of 6.3 looks expensive for a business that's not improving as quickly as I would like to see when they're losing money on the bottom line. When a company is already profitable, I don't need to see them improving all that quickly. But when they're losing so much money on the bottom line, over $200 million in the 9 months, I want to see better improvement. I want to see improvement more quickly when they're losing so much on the bottom line. So overall, C3.ai is an innovative company, an AI company in a category that's growing rapidly, and C3.ai has demonstrated 2 strong years of improvement. The company's improvements in cash flow from operations are excellent. The last leg I would like to see from C3.ai before I can upgrade this stock is better performance in terms of operating income or a more quicker approach, a more quicker improvement in cash flow from operations. So to me, this company has made great progress in 2 years. However, it's just not quite there yet for me to rate the stock as a buy. The risk versus reward is just not yet favorable enough, although it's almost there. So I'm still keeping the stock rated as a hold for now. Hey everyone, I'm excited to announce that my book is finally available for sale. I've been working on it for more than a year now, so I'm really excited to finally share this with you now. It goes through my framework for evaluating stocks. Some of you often ask why I like this stock or why I like the other stock, and this framework provides you the things that I look at when I'm evaluating stocks. I've added the link in the description below.